all the participants to watch later on. And there will be question and answer session at the end. Now I would like to invite Mr. Shakur, founder of Lexicon, a prominent business education and training organization. Mr. Shakur.
Thank you. All right, so I believe you can hear me as well.
Yes.
Okay. So on behalf of Lexicon Education and OASIS Consulting, I welcome you all on this wonderful webinar on successful implementation of IFRS 9. Sorry. So I believe now you can hear me. So I was just saying that thank you very much everyone for joining us today for this wonderful session on IFRS 9. So without wasting time, what I would like to say is to start session by Inam. But before moving on, yes, this session is being organized by Lexicon in collaboration with OASIS Consulting. And at Lexicon, what we do is we offer educational programs, that is a certified financial modeler, advanced diploma in accounting and finance, certified CFO, and diploma in international financial reporting standards, that is awarded by Institute of Financial Accounting UK. And we also provide corporate in-house trainings in Pakistan and international markets as well. And OSIS Consulting is also leading an emerging consulting organization dealing with IFRS and some other services. So over to you, Inam sir.
Thank you, everyone. Thank you, every participants for joining this event. And I'm looking forward to have a wonderful event. Thank you, Lexicon, for inviting me for this event as a guest speaker. I'd like to give you a bit of introduction about myself, and then I'll share my screen so everyone can see a brief presentation about the upcoming event. I am Inam Rahman. I am CEO of OASIS Global Consulting Private Limited. By profession, I am a chartered accountant and a CPA from UK and CPA from USA, and I have a SOCPA membership from Saudi Arabia as well. I started my career from PwC Pakistan from the assurance department, and then I moved to PwC Saudi Arabia. I spent around 5 years over there in the Riyadh office as in the assurance department, and then I moved to Deloitte, Saudi Arabia. I also spent around a couple of years over there as a in the assurance department, and then lastly, I was working in a leasing company as director of finance and head of treasury. This session, I'll share you my screen so everyone can have a look about it. I hope everyone is looking my screen.
Yes, yes, your screen is visible.
So this session is about IFRS 9 management. IFRS 9 management and IFRS 9 technical contents is slightly different. I would like to give you more of a focus on the management side rather than the pure content and technical ground side, because technical in most of the geographical locations, IFRS 9 is already adopted. Many of you have already familiar about what technical changes IFRS 9 have published as compared to IS 39 or the local gaps. So I'll give a touch base about IFRS 9 content slightly, and my main focus is on IFRS 9 management. As you people know, IFRS 9 was published by IASB in 24th of July 2014, and with an effective date of 1st January 2018. IFRS 9 is purely about financial instruments, its classification and measurement. Second one, impairment, and the last one is hedge accounting. It is actually a replacement of IS 39. Most of the companies and countries have already adopted IFRS 9 in 2018. And some of the companies or some of the countries have deferred it due to some local requirements, and they are also in place from this year or next year to implement IFRS 9. Our main content for this webinar will be distributed into these 4 parts. Part 1 will be the key considerations and challenges. Part 2 will be the OASIS best practices approach. Part 3 will be designing a strategic end-to-end ECL framework. And the fourth one, we will leave it for the audience to have a question and answers. They can submit your question and answers in the meanwhile of the presentation, so on the chat box, and we will take it at the end of this webinar. And if there is a slight time shortage, then we will share our email addresses, and you can send your questions on that email address, and we will answer that separately. First, we have for the first part of key consideration and challenges to IFRS 9 transition, we have separated into some 8 to 9 main themes or main parts, which is visible on the screen. The first one is actually the highly technical and complex standard. Why I'm saying this standard is technical and complex as compared to other standards, for example, IS2, IS19, even the new standard, which is IFRS 16, is because there's a major mind shift required to adopt this IFRS 9 standard. As compared to other, for example, IFRS 16, what's the roadmap? Roadmap is that we will identify the main gaps between the current requirement and the new standards. Then we will identify some adjusting entries, and then we will post those entries. And at the end, there are some additional disclosures in the financial statement. But in IFRS 9 adoption, there's a major shift of mind required. It is a highly devoted standard. For example, I'll give you one very live example. When I was doing an audit of a bank in Saudi Arabia, on 31st December, which was the last day of year end, there was a very big loans and advances customer corporate banking have brought into the bank. And everyone was very happy that this corporate banking department have done excellent work. They have brought a very, very big customer, and obviously this will boost our balance sheet. This will boost our income from the revenue side as well. But on the same day, the risk department and the finance department came and say that, hold on, you still need to have record a provision in the books on 31st December, an impairment in the books. Corporate banking department said that why there is a need for impairment, because there is no default event so far. This customer have excellent financial track record. They have given us more than the tangible collateral. So why there is a need for provision right now? We always book a provision when the default event occurs. So this is actually a mind shift. Previously, we were recording provision under IAS 39 as per incurred loss model. Incurred means when actually the event of default came into picture. Now this is shift from incurred loss model to expected loss model, means there could be a possibility that some of the events came into future that will result in this current and regular customer default, and then you have to record a provision now in the books. That is a major shift. Secondly, this is why I'm saying this is a complex standard, that everyone knows that because it is a financial instrument and it is more or less relying on impairment. So it is more or less linked with receivables. So if you have receivables in the book, you need to have a provision in the books, and IFRS 9 then comes into the picture. However, the scope is very widened in IFRS 9. IFRS 9 deals about the financial assets which are at amortized cost, that is obviously your trade receivables. IFRS 9 as scopes in financial assets that are through fair value through OCI, lease receivables, your financial guarantees, your loans and commitments. Again, I'll give you another example. I was doing an audit of an asset management company, and they have a cash and balance on their balance sheet, and this cash and balance is deposited into their parent bank, and that parent bank is actually their holding company, and this cash and bank is in the current account, and they can withdraw anytime this cash and bank balance. But still we as the auditors have pushed them to record a provision. Now, anyone, what's the argument from management side at that point, that why we need to record a provision? Because this is a cash and bank balance, amount is in current account, we can withdraw any time, any amount as we want. There is no default because the bank is our related party. But still we say that as per IFRS 9, you have to see that it was quite possible that this bank in the future will go bankruptcy, and there are some amount which will be defaulted for you. So for that particular gap, you have to record a provision through probability of default. This is called in IFRS 9 terms PD, and this captures actually the future event of default through macroeconomic overlays. So this is the part one, bullet number one, highly technical and complex standards. Second one is system infrastructure requirement. Obviously, this is related to big companies, big banks primarily, where you have to invest heavily on infrastructure or systems to keep you updated or to keep you up to the mark that you will be able to do IFRS 9 modeling. Small companies, SMEs, they can still do IFRS 9 modeling their uh, through their Excel base, but for banks, it's not possible, or big companies, it's not possible, because these banks and these big companies have quarterly reporting. If you keep this on a manual form or an Excel based form, that every month or every quarter end you have to rerun the model, you have to generate the adjusting entries, you have to record this provision. So one can understand how much a big task it will be, or how much a small error will lead to such a big disaster. So what every big companies and big banks have done who have adopted IFRS 9, they have created the separate systems, and they have hired data mining experts or data cleansing experts, actuaries, statistical experts who have done a huge investment on their data, and then link this data with their core banking or core accounting system. This way they have achieved a very optimal result, but obviously this is a cost. So this is one of the challenge again for IFRS 9. Third one, which is capital, balance sheet, and income volatility. It's a proven research that so far the companies who have adopted and the countries who have adopted IFRS 9, you have to keep this in a mind that your balance sheet will approximately goes up in terms of provision by around 20 to 25%, and your income statement will approximately come down from 30 to 50%. Why this is a mismatch? The mismatch is because on the balance sheet, there is an increase of obviously a fixed asset cost and your provision. But on the income side, you have the impact of, first of all, provision charge. Then you have the impact of general and administrative expenses, because you have to hire consultants, you have to pay them the fees. You have, there is a charge of depreciation for infrastructure addition. So all these you have to keep in mind that once IFRS 9 is being adopted, your balance sheet and your income statement will show volatility, and a big volatility. Fourth one is developing an entity-wide risk policy framework, and this is in many cases most ignored one. Why I'm saying so? That people are thinking that, okay, we have there's an IFRS 9 in the picture, we will bring a consultant from outside. Some big organizations hire big fours, or we will develop an in-house expertise, and then we will develop a model, and then we will come up with a provision, we will record this into the financial statement and go on. However, the best practice is that, and this is a big challenge, because it has to be adopted from the top. Best practices which is there in the market is that there is a risk committee, and this risk committee is actually the representation of a board, And this risk committee have stakeholders from different departments, primarily from finance, from risk, from IT, from business, and from MIS. Mostly these are the stakeholders, and then they develop a framework, a roadmap of IFRS 9 implementation and then IFRS 9 upgradation. Why I'm saying so, because it has to be adopted, it has to be approved from the front. For example, if a company is in a leasing business and the customers are only retail customers, there could be a very possible reason that if you are just focusing on the retail customers, IFRS 9 provision will have a major impact, because the retail customers or private customers are more pro to default as compared to corporate customers. So there could be a possible reason of strategic shift that it will. My screen is visible to everyone?
Excuse me, Mr. Inam.
Yes, my screen is visible for everyone.
Mr. Inam,
Yes.
can you please make slides in full screen for better view?
Okay. Is it better now for everyone?
Yeah, it's better now.
Okay. So I'm saying that this entity-wise risk policy framework, it has to be adopted from the top level because there's a strategic shift required. This framework will dictate also that what are the portfolio size, which model we will adopt, what are the PDs we will take, what are the collateral valuations we will take, what are the frequency of review of this model, what is the frequency of upgrading the inputs into this model, who will approve this model before it is recorded into the trial balance. So mostly this part is a bit ignored, but this, if anyone adopts, it's a best practice and it will give a very clear guideline how to smoothen the IFRS 9 transition. The fifth one is data and modeling. Data and modeling is data. Obviously data is very, very important, and as I've mentioned in my previous slide, that many organizations, especially the banks, have invested a lot to get the data on which the IFRS 9 model will be based. But from modeling side, you have to also ensure that you are well aware there are different models which are given into IFRS 9 relevant to particular industries. For example, if you are a manufacturing company and if you have only trade receivables, you are not required, or it is not preferred, that you will go for 3 stages IFRS 9 model. You can adopt easily a simplified approach. A simplified approach is similar to your provisional metrics, where you will take the past default and you will put up certain macroeconomic overlays for future, and then you will do the model. So fifth one, the modeling, selection of modeling is again a challenge for the companies. They were not aware of that which model is best fit to their business rationale and business practice. So that has to be very well adhered before adopting a model. Cost involved. Cost involved is very primary concern for major companies. I'll give you an example. When in 2018, the banks were adopting IFRS 9. Before that, 2018, 2017, you have to record, as per IS1, you have to give an impact of IFRS 9 into their financial statements for 2017. So banks have hired big consultants, and those consultants, just to develop that model, charge around millions of Saudi riyals to build that model, millions of Saudi riyals, and I'm not exaggerating this one. And on the top of it, when 2017, when there's a disclosure just published into the financial statements, to review those disclosures, the auditors, and in Saudi Arabia, there has to be two audit firms doing simultaneously the audit of the banks. So both firms approximately charge in 2017 around 500,000 Saudi riyal. So this much of cost you are talking about when you are implementing IFRS 9. But obviously the magnitude of the cost varies. For banks or for big institution, this is the range, but for small institutions the amount is pretty much low. But obviously there is a cost element involved, and this is a challenge for many companies. The second last point in this part is risk and finance integration. And why I'm saying risk particularly, because we have to have a fair balance between what is required under IFRS 9 as a provision and what is required as per the business rationale. Your IFRS 9, as per the finance or as per the risk team, they can come up with a huge provision. And I'll give you an example that once we have received in a company, we have received a provision. This is a live example. It happened to us as well, that we have received the model to record into the financial statements. And that number was huge. When it comes to finance, we match it with what is right now recorded into our trial balance, and the difference is so much that it will eat up all our profit for the whole year. And when we dig into it, we found that there is a macroeconomic factor of unemployment that was put in, and that has resulted increase in IFRS 9 provision exponentially. But we as a finance said that our customers are mostly government customers. So government customers, there is no correlation between unemployment rate and government customers. They have no effect of unemployment for government customers. So why we are taking this macroeconomic factor in IFRS 9 provision? So when we eliminated this factor, this our provision have reduced significantly. So that's why a risk and finance integration and risk and finance collaboration hand to hand is very important. You should not rely that at the end risk will give you, or the particular department will give you IFRS 9 model and provision, and finance will just step in, take the number and record into the financial statement. If this is the case, it will not give you most optimized result. So this is one of the consideration, one of the challenges. The last one, which is now very much relevant for in the current scenario, is the COVID-19 impact. uh, COVID has impacted, this pandemic has impacted everyone. Most of the industries have been facing a lot of liquidity crisis and profit shrink. So that's why it is also very important that we need to understand that in this situation, the probability of default percentages will increase as compared to previous years or previous to previous years, for sure. Because if, especially if you are into a retail business, if you are in a customer's base who have affected significantly by IFRS 9 by in a way that their jobs have been gone or their salaries have been reduced, so there is very high probability that they will become default into the near future. So your probability will increase and your IFRS 9 provision will increase. Secondly, your macroeconomic factors now becomes most relevant and slightly changed from previous one. Previously, you were taking inflation rate. Now you have to think about your GDP, you have to think about your oil prices, you have to think about unemployment rates, and this has to be incorporated into IFRS 9 model. So overall, the COVID resultant, most of the cases will result into increase of provision, and it could be a major challenge for many companies who are adopting IFRS 9. Now we will tell you what is the OASIS best practice and how we have actually developed a roadmap which will effectively help companies to implement IFRS 9 provision smoothly. This is a slide steps, or we can say roadmaps, which we recommend and which we have implemented in many companies, and they have benefited from IFRS 9 management. First one is the managing the people challenge. So as I mentioned in my previous slide, that there is a major shift or major transition required, transformation required in the mindset, and that will require definitely some sort of training and awareness programs that has to be done upfront, so the resistance or will be minimal. And from OASIS, we have a team of experts who are trainers, who are corporate trainers like Lexicon, who can give trainings to the top management, to the middle management, to the lower management, that what has to be changed and what has to be adopted to have a very smooth IFRS 9 implementation, upgradation, and transition as well. Forecasting step 2 is also very, very important, because when you are preparing your forecast, we can help you. OASIS can help you in preparing different scenarios, which could be from severe to mild to moderate. And based on these scenarios, we can do stress testing and we can build a forecast. That forecast will be for your sales forecast, your expenses forecast, your income statement forecast, your balance sheet forecast. So everyone will know at the heads up and upfront that what could be my balance sheet looks like if these events will come in the near future or in a year. So there should be not a shock at the end to all the stakeholders, your shareholders, your auditors, that what happened to your balance sheet, what happened to your income statement. It shows that you are readily prepared for this one. Your budgets and the cost elements are very important, as I mentioned, and here we can also prepare budgets for the companies. We can incorporate the number of infrastructure requirement that is needed and what would be the cost of that one, what would be relevant depreciation for those ones, how much staff you need to employ, what would be the prices for consultants. So all these elements that are needed to implement IFRS 9, we can build a budget for them upfront. That budget has to be approved by the board, so everyone knows that how my balance sheet and income statement looks like at the end of the year. Data problem is very, very important, and we have evidence that this is the major concern for many companies, especially the auditors as well. The data is not right, or the company does not know from where they can get the data. So we have a team of data mining experts and we have a team of data cleansing experts. Data mining experts are actually those who will gather the data from different sources, who will sit with the management, with the data team in the system, and who will identify where are the data actually being lied. And from these places, they will gather those data. And the data cleansing is actually to refine the data in information that can be used as an input in the IFRS 9 modeling. So this step 4 is also very relevant, and OASIS can help in solving this problem for the industry. System integration is again very, very important. As I mentioned, for banks and for the financial instruments institutions, keeping the IFRS 9 model on IFRS on Excel or a manual will not help, will actually become disaster. So we have a team of experts who have actually implemented IFRS 9 from a technical point of view, and who have integrated also IFRS 9 model with their core accounting or banking system. And in this way, at the end of each period, either it is month or it is quarter or it is semi-annual or it is annual, system will automatically generate IFRS 9 provision and automatically be reflected into the financial statements or the trial balance. Obviously, there are some levels of review and approval required, but to perform manually IFRS 9, that is not there. And last but not the least, monitor and refine. Especially in the age of this pandemic, you cannot rely on the model which was being developed in 2018. You have to refresh the input assumptions used in that model, particularly your macroeconomic overlays, your probability of defaults, your default periods. And here we can also step in and we can also refresh your model or rebuild your model as per the current requirements of industry. And this last two slides are actually the designing a strategic end-to-end ECL framework. There are 8 symbols that we have taken. Hello, am I audible to everyone?
Yes, you are.
Okay. This is actually a recap of what I have said in my previous slides, is that your strategic end-to-end ECL framework is very important. And for this, you have to build an in-house IFRS 9 committee. We recommend that this should be in-house, not outsourced, because in this way, the responsibility relies in-house and they need to know and they are better aware of what the company is actually requires. So it should be an in-house committee. Second is choosing the right ECL model. As I mentioned, that it has to be relevant with your company's profile. You will either go to a model of simplified approach, or you will go to a full-fledged stage 3 IFRS 9 requirement. If even in stage 3 IFRS 9 requirement, there are many models. Some can adopt roll rate model, some can adopt statistical model. It's again very relevant and very particular to a particular company and its needs. So this is also very important. Independent data integrity check, very important, as you know, if the garbage in, the garbage out. So the data which you are, once you have built an in-house committee, you have identified which model you have to adopt. Now you have to know where is the data and how the data will be checked for its integrity, accuracy, and completeness. So you have to ensure that your data is right, which you are putting into the model. Your assumptions is very important again, as particularly these days, your probability of default. I can give you an example on this one as well, that in IFRS 9, there is the assumption of event of default, and standard says that the standard event of default is 90 days. Means after 90 days, the customer will go into stage 3 and there will be a lifetime PD for those customers. However, it is a rebuttable presumption, and that's why I'm saying that your assumptions needs to be challenged at every stage. For example, if you are dealing with customers who are all government customers, so government customers never pay you in within 90 days. Maybe in the case of government customers, your event of default is 200 days. So here you have to challenge that assumption and you have to change the event of default from 90 days to 200 days. Otherwise, you can imagine that on each 90 days, you are recording a huge provision, which is in fact not the right approach. So this is again very important to consider. This one ensure compliance to regulations, very particular these days, because many countries have not adopted IFRS 9 in its essence. In fact, they have adopted IFRS 9 with slight modifications relating to their local environment. I'll give you an example. Saudi Arabia, they have just recently issued a guidelines for IFRS 9 credit provision for finance companies, in which they have in fact broadened the scope of IFRS 9. Previously, as per IFRS 9, there are 3 stages: stage 1, stage 2, and stage 3. And now this is moved from stage 1, stage 2, stage 3 to 5 stages. So you need to ensure, you have to be very particular that when you are adopting IFRS 9, you are aware of what are the local regulatory requirements as well. And using and adopting macroeconomic factors, very important point, that which macroeconomic factors you have to use, it has to be correlated with your portfolio. As I mentioned, that in some cases, unemployment rate is not a macroeconomic factor for you. For some companies, it has to be. GDP can be, inflation rate can be, your company's funding, your country's funding could be a macroeconomic factor. Someone can ask that from where we can get this macroeconomic factors. So there are lots of agencies, particularly government agencies, which publish this macroeconomic factors for future. And some companies also can get this data from Bloomberg, from Moody's, from S&P. They publish these data for future economics and future years as well. So there you can get this data. Testing the model and frequency of testing. Usually IFRS 9 recommends that you have to test the data and you have to test the PDF in a year at least. But during this pandemic age, it is advised that you will test the data at least in 6 months, and you will upgrade your assumptions, and you will upgrade your macroeconomic factors, your probability of default factors every 6 months, so that your data will become up to date. And disclosure requirements. Lastly, disclosure requirements, as I mentioned, IS 1, there is a requirement to give the disclosure, and then there are lots of disclosure in IFRS 9 that has to be recorded or has to be presented into the financial statement. First of all, obviously, the movement of provision, then your movement between each stages, your stage 1 to stage 2, your stage 2 to stage 3, your probability of defaults, your cure periods. If there is any restructuring, you have to give the details of those ones. So this is primarily end-to-end ECL framework that we thought would be beneficial for the audience to implement IFRS 9. I will now leave the floor to the audience. So if they have any particular questions, they feel free to ask. I have got a question that what is ECL? ECL is actually expected credit loss. This is the term which is given into IFRS 9, that you have to record a provision on your credit losses based on your expectation of future years. Previously, it is incurred loss model under IS 39. I think this is, I don't see any much questions here. I will wait for 5 more minutes. If they have any question, please feel free to ask.
Mr. Inam,
Yes.
we have the other questions like, what do you mean by credit loss? There's a question from Shehzad Usmani.
Credit loss is actually, it calls you have receivables in your books which are actually a credit, and how much you can bear a loss, or you can accord a provision if there is any event of default in those credit losses. For example, if you have a receivable of 100 and you will end up receiving 90 from that customer, so 10 is actually a credit loss or a provision which will record under IFRS 9.
Okay. There is another question.
Yes.
Various countries have given a debt moratorium. How to incorporate them in the model?
Okay, that is very relevant question. As I suggested, that it has to be built into your probability of default and your macroeconomic overlays. So it depends what macroeconomic overlays you have added. Obviously, in your probability of default, once you have taken the data from your past, then you will build up this debt burden on that macroeconomic factor to make your probability of default futuristic.
Okay. There is another question from Mr. Mirza. For AR, aging is used as a basis for ECL. What bases are used to calculate ECL for other financial assets like cash?
This is very important question. Yes, for receivables, we use aging. For cash, what we have seen in different market that it depends which bank you have placed your cash and bank balances, and then you will see what is the rating given by Moody's or given by S&Ps for those banks. If it is, for example, the highest rating AAA, then your probability of default will be very less. And if it is, for example, the rating is bit low, which is BB minus, BB plus, then your probability of default will be a bit high. Anyone can see that from where we will get this rating. So every bank publish on their website frequently and in their financial statements that what are the ratings of those banks as per this big agencies, Moody's or S&Ps. You can get that rating from there, and from there you will develop probability of default.
Okay, that's good. There is another question from Viona. What industry is more impacted by IFRS 9?
IFRS 9 have impacted every industry. Every industry who has adopted IFRS 9, International Financial Reporting Standards, they have to book a provision under IFRS 9. But which industry is majorly affected? It is financial instruments, particularly the banks. Insurance have not adopted IFRS 9 so far because as per insurance, they have to adopt IFRS 17, which was due, I think, in 2022, and now it's deferred till 2023. And under IFRS 4, insurance companies will adopt IFRS 9 when insurance contract, which is IFRS 17, will be adopted. So the answer to your question is all the companies have been impacted, but primarily the major impacted companies are banks and leasing companies and asset management companies.
Okay. Okay, there is a question about the recording of the session. Can we access the slides and recordings, and how? There's a question from Mir, Mr. Mir.
Yes, we can share the recording and we can share the slides to you. After this meeting, we will share a link to everyone from where they can download this video recording and the slides.
Okay. Here we have a question from Taha Ali. How we can take the benefit of collateral in ECL calculation?
Very important question. Benefit of collateral is actually being taken into LGD. LGD is actually loss given default. The formula to calculate provision of IFRS 9 is EAD, which is exposure at default, multiplied by PD, which is probability of default, multiplied by LGD, which is loss given default. So for example, you are an auto lease company and you have given customer cars on lease, and your portfolio is, for example, 100 million, and your probability of default is actually 40%. And those cars are actually, because it's on lease, so it is on the name of that leasing company. And if the customer defaults, you can confiscate that car and you can sell it into the market and you can get some money. So in this case, for example, if the car value is 100 million, and the for sale value of those cars is, for example, and it is obviously evident from your previous history that in the previously last 3 to 5 years, you have confiscated 50% of the cars, and the for sales value of those cars is, for example, 35%. So this 35% will be taken into LGD. So your LGD will be the collateral for sales value. Here you can take the effect of collateral into the IFRS 9 provisioning calculation.
Okay. Okay, there is a question. That is, can you point out or list some significant disclosures for our knowledge, for their knowledge?
I think I mentioned this one, but I will mention it again. That one is obviously your provisioning movement, that how much is your opening provision. One is very important, thanks for asking the question from the audience, that if you are adopting this for the first time, you have to ensure that there are two ways through which you can adopt IFRS 9. Either it is full retrospective approach, where you will show three balance sheet, and the impact will be taken on the opening balance sheet, and the third one, which is before opening balance sheet and then this year. And the second one which is allowed is modified approach, where you are not presenting three balance sheet, you are presenting similarly the two column balance sheet, and the impact of everything will be taken on the opening retained earning. 90% of the companies and organizations have used this approach or adopted this approach. Other than this, obviously you have a provisioning movement, where you will say, well, how much is your opening provision, how much is your charge, how much is your recoveries. Then there is a provision of staging movement, that how much your provision, not provision, how much is your portfolio in different stages, which is stage 1, stage 2, stage 3, and how much is the provision for each stages. Then there is a requirement of movement between stages, that how much is moved from stage 3 to stage 2, stage 2 to stage 1. So all these are requirements. These are major disclosure requirements. Obviously, there are other requirements as well, which are very clear into IFRS 9 standards.
There is a question from Salman Yusuf.
Yes.
Is it possible that for a given customer with a specific credit profile, two different entities in the same economic environment would have two different PDs?
Yes, it is quite possible that one customer have taken a loan from two different banks and in the same geographical location. But for example, for one bank, the customer has no event of default, and for another bank, the customer has some event of default. So there could be two different PDs for for a single customer in the same location with different companies. But if there is one customer who has two loans with a single bank, means two line of, when he has taken a short-term loan and one he has taken a medium-term loan. And in short-term loan, he has a default. Maybe he has 91 days overdue and the bank default date is 90. And for medium-term loan, he is regular. But IFRS 9 says that you have to take the highest of the default event. So in this case, you have to take stage 3 for both of its credit lines. Similarly, if standard says also that if a customer has on balance sheet and off balance sheet as well. For example, the customer has loans and the customer has also LCs and LGs. So if the customer has default on its on balance sheet loan, we have to consider that his off balance sheet is also defaulted and take the provision on that one as well.
Okay, there is no more questions.
Thank you very much, everyone. I'm looking forward to have a feedback from your side. And if there is any other questions which are left, you can contact on the email address which is mentioned on the screen. And thank you all. Thank you very much.
Thank you so much, everyone, for the participations.
What?
And you people have the Inam's and company's profile to help you connect for queries. Thank you so much.
Yes.
Okay, good.
Ah!